With the Fear and Greed Index hitting 34, ENPH's 14% technical breakout is a trap if you ignore the Level 2 policy risk. The only structural floor in this market is the Blackwell hardware cycle, where architectural dominance is decoupling NVIDIA's margins from the macro noise. Let's break down why that ENPH's cup and handle pattern is a hold despite the double-digit morning surge. ENPH's energy earns a 52. Hold, not buy. The cup and handle breakout targets $184, pricing in full energy system adoption. But gross margins fell to 34.6% in Q1, down from 49.1% last year, as inventory write-downs hit their European warehouses. The technical pattern hides a supply chain rot no chart can fix. ENPH's Energy's hardware mode is currently under siege because their IQ8 microinverter architecture relies on a 55nm process node, the specific semiconductor manufacturing generation that defines transistor density, which cannot match the power density of newer wideband-gap competitors. While Wall Street cheers today's 14.31% jump to $48.01, the silicon reality is a looming TDP, thermal design power, or the maximum heat a subsystem can dissipate, wall. ENPH uses an ASIC, application-specific integrated circuit, a custom chip designed for one task, to manage burst mode current. However, Tesla's latest Powerwall integrated inverters are moving towards SiC, silicon carbide, a material that handles 3 times the voltage of standard silicon. This allows competitors to shrink the footprint while increasing efficiency beyond ENPH's current 97.2% peak. The lab views this technical stagnation as a structural risk despite the short-term price surge. ENPH's microinverter advantage has always been its distributed architecture, but as the industry shifts toward HBM, high bandwidth memory, used here for rapid data processing in smart grids, the IQ8's processing latency becomes a bottleneck. We are seeing a pivot where gross margins, which fell as revenue dropped to $0.28 billion in March 2026, are being squeezed by these older, more expensive 55nm components. While the RSI, Relative Strength Index, a momentum oscillator measuring overbought conditions, at 74.0 suggests a technical rally, the engineering data shows a firm losing its lead in power conversion efficiency. Today's move is a liquidity event, not a reflection of superior silicon performance in an increasingly CC-dominated market. Quarterly financials showing modest revenue momentum for ENPH. ENPH's Energy is currently caught in a violent pivot toward domestic industrial protectionism that transforms its 27.7% short float, the percentage of shares held by investors betting on a price decline, into a volatile spring. While revenue growth has cratered at negative 20.6%, the macro environment is shifting from a search for cheap liquidity to a desperate hunt for domestic energy security. Kevin Warsh is taking the helm of a Federal Reserve where the yield spread has normalized to positive 0.46%, the difference between long-term and short-term interest rates. This normalization signals that the era of easy money is over. With the Fed likely on hold and inflation risks rising due to Greenland trade war, tariffs, ENPH's cost of capital is permanently higher. However, the lab sees a transition from just-in-time to just-in-case manufacturing. This shift forces a re-evaluation of ENPH as a critical domestic infrastructure play rather than a discretionary solar stock. The geopolitical friction of escalating trade protectionism is the new invisible hand moving this stock. As the U.S. moves toward a high-tariff regime, ENPH's ability to absorb higher COGS, cost of goods sold, the direct costs of producing the microinverters, becomes the primary differentiator against global competitors. Wall Street is obsessed with the negative 20.6% revenue growth, but they are ignoring the architectural moat required to survive a trade war. The 6.6% recession risk priced by prediction markets suggests a cooling economy, yet domestic industrial capacity is being prioritized by current policy. We are watching a structural migration where government policy acts as the ultimate capital allocator. The lab views the current 14.3% price surge not as a random tech bounce, but as the market pricing in a world where domestic energy hardware is protected by a tariff wall. ENPH is no longer a solar company. It is a geopolitical hedge. ENPH reported earnings per share of $0.47, beating the Wall Street estimate of $0.42 by 12.2%. A solid beat that signals strong execution. ENPH is trending higher, currently at $48.01. ENPH just wrapped earnings with a 12.2% EPS beat, 47 cents actual versus 42 cent street estimate. And the press release led with record microinverter shipments and expanding AI-driven demand. That's the glossy headline: growth, innovation, margin expansion. But insiders sold 137,250 shares in the last 90 days. When executives dump stock after a beat, the official story is diversification or estate planning. The lab hears something simpler. The top floor sees the order book peak and is locking in gains before the cycle turns. That's not fear, it's timing. The EPS beat is 1 quarter. The R&D trend is the real story. ENPH cut R&D spend 6.1% year-over-year while revenue grew. That's a deliberate pivot from pipeline investment to margin protection. Management calls it capital efficiency. The lab decodes that phrase. We are no longer betting on the next architecture. We are milking the current one. Meanwhile, the earnings call script buried a boilerplate line. Information on the company's website is not part of this report. That's legalese for don't trust anything outside the 8K. What they're not saying is louder than what they are. Supply chain concentration risk in Southeast Asia, tariff exposure on every microinverter, and a product roadmap that suddenly looks thinner. The official narrative is growth. The PR filter reveals a company quietly battening down for a margin squeeze. The momentum breakdown for ENPH. RSI sits at 74, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above 0. ENPH is currently riding a cup-and-handle pattern, a technical formation where a rounded bottom is followed by a brief consolidation before a breakout, signaling that the market is finally pricing in their architectural shift from simple microinverters to full energy systems. The bullish options flow with a 0.20 put/call ratio. The number of bearish bets versus bullish ones confirms that smart money is betting on their ability to dominate the smart home energy management layer. But here is what breaks the bull thesis. An RSI of 74.0, relative strength index, a momentum oscillator that signals a stock is overbought when it crosses 70, means the technicals are screaming for a pullback. While the handle is forming, ENPH is still trading below its 200-day moving average of $39.01, and with a forward P/E of 19.7x, the price-to-earnings ratio based on next year's projected profits. The market has zero tolerance for any execution slip in their high-margin software integration. The question that makes management sweat is this: can ENPH maintain its margin moat as the Fed's high-tariff regime forces a pivot to domestic manufacturing? The lab's answer is no. While the Inflation Reduction Act provides a 30% tax credit tailwind, the cost of scaling U.S. capacity to avoid Chinese component tariffs will cannibalize gross margins before the software revenue scales. We are seeing a classic PR pivot where management highlights system reliability to distract from rising bill of materials costs. The lab's verdict: with an AI score of 52 to 100, we are neutral until ENPH clears the $48.01 resistance level on heavy volume. Watch the $35.81 level as a critical entry point if the handle fails to hold. This is a show-me story where the hardware reality must finally catch up to the glossy PR narrative. By NVIDIA, Lab score 66 out of 100. The Blackwell architecture's 1.4 petaflops per GPU enables 40% faster training on trillion parameter models versus Hopper. Mainstream analysts miss that 85% of this performance jump comes from B100's 4nm yield-optimized design, not just memory bandwidth. Tariff exposure is underpriced. 70% of CoWES packaging still routes through Taiwan. NVIDIA's dominance is currently anchored by the Blackwell B200's massive 800mm superscript 2 die size, the physical area of the silicon chip, which pushes the absolute limits of the lithography reticle. While Wall Street obsesses over quarterly revenue of $215.94 billion, the real story is the interconnect. Blackwell utilizes NVLink 5.0, the high-speed interface allowing GPUs to talk to each other, providing 1.8 terabytes per second of bidirectional bandwidth. This is double the speed of the previous Hopper generation. Compare this to the AMD MI300X, which uses an impressive chiplet design but struggles with higher latency, the time delay and data transfer when scaling to massive clusters. NVIDIA's lead isn't just about raw compute. It is about the CoWES, chip-on-wafer-on-substrate packaging, that allows them to fuse two dies into a single unified processor. The lab is tracking a critical shift in the engineering mode as we approach the May 20th earnings. NVIDIA is migrating to HBM3E, high-bandwidth memory that operates at 1.2 terabytes per second per stack, which is essential for feeding the hungry Blackwell cores. While competitors face sick wafer defect density issues, the number of flaws in the specialized silicon carbide crystals, NVIDIA has locked down TSMC's 4np process node. This is a refined 5nm manufacturing process optimized specifically for high-performance AI. With a market cap of $5.7t and a beta of 2.24, a measure of volatility relative to the market, NVIDIA is moving like a high-growth startup despite its size. Today's 4.39% climb to $235.74 proves the market is finally pricing in the structural scarcity of high-yield Blackwell silicon. Quarterly financials showing modest revenue momentum for NVIDIA. NVIDIA's 73.2% revenue growth is the only force capable of outrunning the 4.46% 10Y yield, the interest rate on the benchmark U.S. government bond, and the inflationary friction of the new high-tariff regime. Fed Chair Kevin Warsh inherits a normalizing yield curve, the spread between short and long-term interest rates, at plus 0.46%, signaling that the era of cheap liquidity is over. With CPI, the Consumer Price Index measuring inflation, at a negligible 0.6%, the Fed is pivoting focus toward domestic industrial capacity. The Greenland trade war and looming tariffs represent a structural shift from just-in-time to just-in-case manufacturing. This forces a radical reevaluation of supply chains. While peers struggle with rising COGS, cost of goods sold, the direct cost of manufacturing silicon, NVIDIA's 95.6% EPS growth provides the capital cushion to internalize these costs. Geopolitical tension is no longer a backdrop. It is a direct tax on the silicon reticle, the glass mask used to print circuit patterns on a wafer. NVIDIA reported earnings per share of $1.62, beating the Wall Street estimate of $1.56 by 3.6%. A solid beat that signals strong execution. NVIDIA is trending higher, currently at $235.74. Part A. NVIDIA's PR machine is humming the same tune. AI demand is insatiable, Blackwell is revolutionary, and the future is bright. Management's earnings call script is polished, every phrase engineered to soothe Wall Street nerves. But let's talk about the 911,732 shares insiders dumped in the last 90 days. That's not a trickle, that's a fire hose. Executives don't liquidate at this scale when they're confident in a multi-year runway. Historically, this kind of exodus precedes a margin squeeze or a demand air pocket, something the glossy press releases aren't addressing. The official narrative says growth, the insider ledger says caution. Part B now, the EPS beat, $1.62 versus $1.56. Looks like a win, but dig deeper. R&D spend surged 43.2% year-over-year, outpacing revenue growth. That's not efficiency, that's desperation. NVIDIA is burning cash to stay ahead, and the market's cheering it like it's sustainable. Here's the PR decode. When management says long-term investment, what they mean is we're throwing money at the problem because Blackwell's successor isn't ready yet. The 10Q would have flagged this as a margin risk, but the earnings call conveniently skipped it. What NVIDIA is saying, AI is the future. What the lab hears, we're one supply chain hiccup away from a 20% haircut. The verdict? The PR is a smokescreen. The real story is in the R&D burn rate, and it's flashing red. The momentum breakdown for NVIDIA. RSI sits at 70, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. NVIDIA is currently riding a near-perfect hardware cycle driven by the Blackwell architecture, the high-performance GPU platform designed for trillion-parameter models. The lab sees massive tailwinds as cloud providers secure multi-year CoWoS, chip-on-wafer-on-substrate packaging that stacks silicon dies, capacity to ensure they aren't left behind. With a forward P/E of 20.7x, the market is pricing in a 25% data center revenue jump as B100 production ramps. But here is what breaks the bull thesis. The RSI, Relative Strength Index measuring price momentum, has hit 70.3, signaling the stock is technically overbought. While the cup and handle pattern looks bullish, NVIDIA is slamming into a $235.74 resistance ceiling while operating under a high-tariff regime. If trade protectionism forces a pivot from TSMC's Taiwan fabs to higher-cost domestic nodes, those 20.7x forward earnings estimates will crumble under margin compression. The question the boardrooms are actually whispering is this: can Blackwell's performance gains overcome the physical TDP, thermal design power, the maximum heat a chip generates, walls that are currently capping data center density? The lab's analysis suggests that while the silicon is faster, the infrastructure cost to cool these chips is rising faster than the compute gains. Management is pivoting to sovereign AI language because they know hyperscaler capital expenditure cannot grow at this triple-digit clip forever. The lab's verdict is a conviction score of 66 out of 100. We are buyers only on a retracement to the $196.50 support level where the valuation aligns with engineering reality. Until Blackwell yields prove they can offset tariff-induced inflationary costs, the risk to reward at this $235.74 resistance is fundamentally broken. Today's top signal, NVDA's 5nm yield jump is accelerating Blackwell shipments. Do you think NVIDIA hits $200 by Q3, or is the tariff risk on HBM3 a brick wall? Drop your call below. We're engineers, not advisors. This is for education, not recommendations. Always verify our data, run your own models, and remember, past analysis doesn't guarantee future moves. Stay sharp, trade smart. This is Denver Stock Lab, signing off.